Welcome and thank you for joining us for part 6. During this session, we will focus on how hedge funds can enhance your return story. We will explain why investing can be compared to embarking on a journey, look at a case study, provide reasons for hedge funds being overachievers when it comes to performance, and end off with the key takeaway. We always say that investing is like embarking on a journey. Some journeys tend to be smoother and more pleasant than others, but no matter how much planning goes into your itinerary, there is bound to be a surprise or two along the way. Your vehicle might break down on the very first day of your trip to the garden route. Your luggage set might be on its way to London while you're heading for the United States. Or indulging in a foreign cuisine has forced you to pay a visit to the nearest emergency rooms. On the bright side, your accommodation could be upgraded to a penthouse at no extra cost, or you could meet someone in Bali that becomes a lifelong friend. The common denominator is the fact that you basically have no control over what, where, and when the surprise will happen, leaving you with no choice but to embrace the well-known saying, "It's not what happens to you, but how you react to it that matters." Being on an investment journey is no different. The financial markets will react to the following: global events, political ties and decisions, natural disasters, financial and social misconduct, and other factors. They all have an impact on economies worldwide. Over the last 2 decades, more or less, the following events have had major consequences for investors. In the early 2000s, we have seen the 9/11 attack in the USA. We have experienced the global financial crisis. The trade war between China and the USA started in 2018, and more recently in 2020, we have seen the impact of the COVID-19 pandemic. In 2022, we have also seen the war between Russia and Ukraine flame up. Depending on how you look at it, it could either be a daunting or exciting thought that many external factors, which you have no control over, have an influence on your journey toward achieving your financial goals. However, we all remain human, and investing can be very emotional, as we have seen in part 2. Most investors agree that they don't prefer to be on the emotional roller coaster if they are experiencing feelings of panic, despondency, and depression. This typically happens when markets fall and they wish that there was a way to make a market downturn less drastic and easier to stomach emotionally. Exposure to hedge funds can offer a solution during these challenging times by positively changing the risk dynamic of the portfolio and possibly even generate positive returns. You might not have any control over the markets, but you do have control over including hedge funds in your investment portfolio. Let's look at a real-life return story and how you can make investment decisions that your future self will thank you for. When we say real life, it means that all data has been sourced from Morningstar for the specific investment period and the portfolio constructions that have been used. It is therefore considered to be accurate for illustrative purposes. Let's dive into your story. Almost 10 years ago, in 2013, you heard about hedge funds and the exceptional value that they can add to your investment portfolio. Hearing about this came at a very opportune time, as you have inherited 100,000 Rand and wanted to invest the money in a fund that will achieve good growth over the long term. You already had a sizable investment portfolio consisting of a combination of traditional unit trusts. At the time, you had 3 options. The first option, you wanted to diversify your portfolio and invest the 100,000 Rand in a hedge fund. The second option, you attempted to stick to what you are familiar with, which meant investing the 100,000 Rand in a traditional unit trust fund. The third option, you considered taking a chance to generate more growth and to invest the 100,000 Rand on the South African stock market. Assessing these 3 options, the question is, which option would you have chosen? In this case, you decided to go with option 1 and to invest the 100,000 Rand in a hedge fund. Since 2013, you have occasionally looked at your hedge fund's investment statement and have been satisfied with its performance. You are now, however, curious about how the other 2 investment decisions would have played out. We pulled performance data to compare how the three investments would have fared over the investment period from January 2013 to February 2022. Here is what would have happened to your 100,000 Rand since 2013. Let's examine the performance of the investments over the last 12 months on a month-to-month basis. Option 1 that you had was to invest in the hedge fund. You'll see that the hedge fund is represented by the orange bars. Option 2, namely to invest in a traditional unit trust, or differently put, an averaged balanced fund, is represented by the black bars. Option 3 was to invest in the South African stock market and is represented by the grey bars. Examining the performance of the hedge fund over the last 12 months, the first thing that you will notice is how much it has fluctuated from month to month, swinging between lows and highs. Looking back, you feel relieved that you remember to apply one of the most important investment principles. Don't evaluate a fund or a portfolio's performance on a frequent basis, for instance monthly, or prematurely, for instance after 1 year when the investment horizon is 5 years, as it is not an accurate depiction of the anticipated performance. It is pointless to look at the performance of an investment every month if the investment's objective is to generate good growth or wealth over the long term, for instance 5 years or longer. You will find yourself being up and down on this emotional roller coaster the entire time, and winning and losing, again winning and losing, may be too much to handle, and you might consider to disinvest prematurely. This could lead to you losing out on the compound growth generated over the years, especially if you disinvest during an unfortunate market cycle. Trust the investment strategy to do what it has been designed to do and allow time to work for you. The reality is, hedge funds with a moderate to high risk profile tend to show considerable fluctuations in value in the short term, just like any other investment with this type of risk profile. But it spreads out over time, and the cumulative effect is powerful. Investors should keep their eyes on the end goal and not be distracted by short-term fluctuations. Let's move on to examine the performance on an annual basis for the investment period. Once again, the hedge fund is represented by the orange bars, the unit trust is represented by the black bars, and the share portfolio is represented by the grey bars. You would be pleased to see that the hedge fund has outperformed the other two investments in most years, especially during market downswings like during 2018. The fact that it has generated positive returns even when the markets fell confirmed what you have heard about hedge funds. They are expected to react differently to the same global news and positively change the risk dynamic of your investment portfolio. Your hedge fund has protected your overall investment portfolio, as your other traditional unit trusts would have struggled during these periods. Lastly, let's examine the cumulative performance over the period 1 January 2013 to 28 February 2022. In other words, what would the difference be in growth and rand value if you have been invested in one of these options over the investment period? Once again, the hedge fund is represented by the orange line, the unit trust is represented by the black line, and the share portfolio is represented by the grey line. The traditional unit trust came in at third place with a cumulative performance of almost 99%. This means that your 100,000 Rand would have grown to almost 199,000 Rand since 2013. The share portfolio came in second place with a cumulative performance of just over 150%, giving you an investment total of about 250,000 Rand. The winner is the hedge fund with a cumulative performance of close to 360%. This means that your 100,000 Rand has grown to almost 460,000 Rand, which is phenomenal. Looking at these figures, you are now convinced more than ever that hedge funds add incredible value to an investment portfolio over the long term. This has really been an investment decision that your future self could thank you for. It seems evident that you made the right decision in 2013, but what explains this superior performance? You are exposed to a more diversified range of asset classes, jurisdictions, industries, and companies, unlocking opportunities that the other two investment options could not offer. These alternative assets reacted differently to the same global news and displayed a low correlation with the other two investments. This effect is highlighted during certain periods like the Nene dismissal, the trade war, and the COVID-19 pandemic. The hedge fund managers took advantage of the broader range of investment strategies at their disposal and could generate investment returns in uniquely different ways. In other words, you have received a different kind of return than what the market produced and have won when markets fell, and may even have won by a greater margin when markets climbed. The cumulative effect of these winnings and winning by a greater margin combined over the long investment period added up and had a substantial impact on the growth of your investment. Seen in the light of your entire investment portfolio, the inclusion of the hedge fund would have provided downside risk protection, ensuring a smoother ride during turbulent market swings. Looking at the outcome and the size of your investment, you are delighted that you have decided to invest in the hedge fund. Truly an investment decision that your future self could thank you for. The key takeaway for this part is the following. Your investment portfolio is exposed to many external factors which you have no control over that will influence your journey toward achieving your financial goals. Including alternative assets in your investment portfolio that will react differently to similar conditions can positively change the risk dynamic of your portfolio and enhance potential returns during market downswings. You might not have any control over politicians, natural disasters, or how the markets react, but you do have control over including hedge funds in your investment portfolio. So, what is next? Be sure to keep your eye on our social media channels for the release of Part 7. We will take a look at Fairtree's unique approach when it comes to portfolio construction in blending hedge funds and traditional unit trusts together.